Greetings, everybody. Welcome to the Liberty Call for Friday, March 17th, 2023. Happy St. Patrick's Day for everybody out there. I'm not wearing any green today. I guess you get to pinch me on the booty. So I hope everybody's having a good Friday, and hopefully the week's going pretty well. Looking at the weekly numbers for the stock market, it doesn't look as terrible as the way things look today, but got a lot of red again on the screen, kind of the opposite of yesterday and the opposite of the day before, where, it's like the Asian markets are green, the domestic markets are red. Yesterday, the domestic markets were green, Asia was red. So it's kind of this volley back and forth, back and forth. All righty. Well, if you're here for the first time, please give me some big old thumbs up, likes, shares, subscribes. Let me move my camera down a bit. There we go. Doing some dusting and cleaning. See all the dust cleaned up off you can even see my beautiful wife back here, my wonderful grandparents. So, all righty. Well, let's go ahead and jump into the numbers for the day. Let's get back up to the top. The Dow Jones finished the day off down 1.19%, 384 points, closed at 31,861. S&P 500 was down 1.1%, closed at 39,616. NASDAQ was down 0.74, closed at 11,630. The VIX climbed today 10.96%. It's currently at 25.51. Canada was down 0.77, Brazil down 1.21, Mexico down 1.16. Over in the European markets, Germany was down 1.33, UK down 1.01, France down 1.43, Netherlands down 0.64, Spain down 1.92, Italy down 1.64, Switzerland down 0.98, and Portugal down 2.42. Russian exchanges both green, MOEX up 2.86, RTSI up 2.34. And the overnights in Asia, the Nikkei in Japan was up 1.2%, Australia up 0.42%, New Zealand up 0.37%. In the Chinese markets, the Shanghai was up 0.73%, the Shenzhen component was up 0.36%, China A50 down 0.2%, DJ Shanghai up 0.57%, Hang Seng up 1.64%, and the Taiwan weighted up 1.52% for the day. All right, well, let me get my weekly chart up here, and we can take a peek at that. Here we go. Let's see how the S&P 500 finished off the week. It looks like it's going to finish the week off up about 2.1%, going back to Monday. Again, these ups and downs, you'd think the whole week was in the red, but technically it wasn't. The Dow 30 is going to finish the week off pretty flat, up 0.12. NASDAQ finishes the week off up about 6.5%. The volatility wasn't nearly as bad here. You don't, even on the down days, you really don't see a huge amount of downward pressure, but we shall see. Dow Utilities finishes the week off here at the bottom of the candlestick, up 4.11, and the Dow Transports will finish the week off up or down 2.03%. All right, well, let's go out to the S&P 500. Let's take a look at the typical or the regular daily chart. Let me add in my lines. You can see here going back to the beginning of last year, this downtrend we've been in. And if you remember, and I'm sure my clients who've just had meetings with me would remember me saying this, that we broke the downward trend in early January. Looks like we're probably going to fall back into this trend line here very, very soon. So, all right. So that's everything as far as markets and all the good stuff there. Let me move some stuff around. Let's go ahead and get to the economic data for the week. All right. Initial jobless claims came in at 192,000. Forecast was 205. Last week's number was 212. So came back down a little bit. Continuing jobless claims came in at 1.684 million. Forecast was 1.715 million. Last week's number was 1.713 million. The consumer price index year over year came in at right on forecast, 6%. Last month's number was a 6.4. The month over month number, inflation still grew by 0.4%. So we're not out of the woods. We're not seeing deflation at this point yet. The producer price index came in at 4.6%. Forecast was 5.4. Last month's number was 5.7. The month over month number, we actually see a little bit of contraction here. So I see this as a positive sign. We'll see if the trend continues into next year or into next month. But the PPI was down 0.1%. Forecast was a growth of 0.3. And last month's number was a growth of 0.3. Retail sales month over month contracted by 0.4%. The forecast was a contraction of 0.3. Last month's number was a positive 3.2. Housing starts grew. This month came in at 1.45 million. Forecast was 1.31 million. Last month's number was 1.321 million. So a bit of a jump in housing starts here in I think this is the February release, or for the February numbers. Industrial production year over year contracted by 0.25%. The forecast was 3% growth, and last month's number was a positive 0.49. So not good there either. Consumer sentiment came in at 63.4. Forecast was 66.9. Last month's number was a 67. And we had seen the last few months it had been climbing a little bit, but it has contracted, probably due to all the bank stuff that's going on and giving everybody the heebie-jeebies. And the index of leading economic indicators month over month came in at a contraction of 0.3. That was right on forecast, and that was the same as last month. All right, so that's all the economic data that came out this week. Let's go ahead and jump over to the market recap. S&P 500 slips on renewed jitters in banks despite rescue deal for First Republic. The S&P 500 fell on Friday as concerns about the banking sector remained a key issue despite a brief reprieve after the $30 billion rescue of First Republic Bank. First Republic fell 26% after suspending its dividend and confirming that it had received $30 billion in uninsured deposits from major Wall Street banks. While this move helped shore up liquidity, First Republic now faces higher interest rate payments from recent borrowing that was necessary to strengthen its finances. Wedbush suggests that this will make it challenging for the bank to turn a profit. In addition, the hit on its balance sheet from markdowns on its loans and securities means any sale will likely be made well below the current valuation. A distressed sale of a bank could result in minimal or no residual value to common equity holders. Bank of America, JP Morgan, and Wells Fargo all fell around 4%, contributing to concerns about the banking sector. However, technology stocks were the relative outperformer, falling just 0.2% and buoyed by falling treasury yields amid ongoing bets that the Fed could deliver its final hike of the year next week and cut rates in the summer. Again, I've been talking about this. The Fed's just been looking for an excuse to, do more QE and more money printing, and that's all that's going to do is lead to more inflation down the road. And when y'all are bitching and moaning because you're paying $50 for milk, I don't want to hear it. Let's see. About 60% of traders expect the Fed to hike next week, down from 80% a day earlier. Tech stocks were also boosted by a rise in NVIDIA after Morgan Stanley lifted its rating on the stock to overweight from equal weight, citing an artificial intelligence-fueled boost to chip demand. On the earnings front, FedEx Corporation jumped more than 5% after the logistics company upgraded its annual guidance following fiscal third quarter results that topped estimates. Meanwhile, crypto-related stocks were in rally mode as Bitcoin surged 7%, helping Riot Platforms, Marathon Digital Holdings, and MicroStrategy Incorporated rack up gains. Overall, the market was characterized by concerns about the banking sector and mixed performance across different sectors. Not great. Again, it's kind of the calm before the storm. I know I've been talking about this for probably last year, even going back to 2019, because I was certain that we were headed into a downward cycle. I had no idea that they were going to print all that money. I had no idea that coronavirus was going to provide the perfect excuse. And again, if I put my tinfoil hat on, I say, well, that was why they did it. They created this BS disease and hyped it up and made everyone think they were going to die, when in reality, he had very little risk of death. So anyways, moving on. Next article, gold hits 11-month high as U.S. banking crisis feeds safe havens. Gold prices hit an 11-month high on Friday, reaching for the $2,000 target that many bullion investors have long predicted. The front month April gold futures contract on New York's COMEX settled at $1973.50 an ounce, up $50.50 or 2.6%, with the session high of $1980.50, marking an 11-month peak. The spot price of gold, more closely watched by some traders, hit $1973.92 at 13:55 Eastern Time, up $54.37 or 2.8%. The session high for spot gold was $1975.24. Gold prices have been driven higher by the U.S. banking crisis, which began the takeover of Silicon Bank and Signature Bank by the FDIC last week, causing depositors to withdraw billions of dollars. Silicon Bank subsequently filed for bankruptcy protection. First Republic is also in trouble despite a $30 billion cash injection from consortium of banks. The crisis has spread to Europe, with Credit Suisse seeking help from Switzerland's central bank. Persistent interest rate hikes from the Federal Reserve have also raised fears of a deep recession. The possibility that the Fed is done with rate hikes could be bullish as for gold, as it would cap the dollar in the short term. If inflation prices proves to be stickier and the Fed has to resume tightening, that would deliver a major blow to the economy and trigger many safe haven flows for gold. Hey, I'm a gold guy. I'm not complaining right now. The last 2 down days of the market, my accounts have been going the right way because I have hedges. Anyways, so that's not a claim of anything that you should be investing in. Please seek advice of your personal financial advisor, or you can give me a call and hire me, and I'll be happy to talk to you in depth. Gold prices have surged as more investors turn to gold as a safe haven to store value amid ongoing market volatility. Spot gold charts indicate that a test of 2,000 is possible if current momentum is maintained, according to chartist Sunil Kumar Dixit. Quote, from this point on, so long as prices sustain above 1960, we can witness a continuation of the momentum reaching for the psychological barrier of $2,000 an ounce, end quote, he said. The last time spot gold hit above 2,000 was March of 2022, when it reached 2070.29, virtually matching the record high of 2072.90 from August of 2020. All right. So, if, things get worse, things that have tangible value are probably not a bad idea to keep your wealth in. All right, last up, it's an article here from LouRockwell.com. It's titled, "The Federal Reserve is the Root Cause of the Banking Crisis," written by Jacob Hornberger. He was one of the libertarian candidates for president in the last presidential cycle. He didn't get the nomination, but he was my choice. I really like Jacob. All right, so and the reason I bring this up is, I saw the dumb idiot Janet Yellen on TV the other day, or maybe today, running her soup cooler that, this is due to Putin's war, and this is due to the pandemic, and blah, blah, blah. No. All this inflation that we're experiencing is due to the Federal Reserve. Stop. That's it. So let's go ahead and read through Mr. Hornberger's article and get my notes up here. The Justice Department's investigation into the banking crisis is unlikely to implicate the Federal Reserve, which is actually the root cause of the crisis, according to an op-ed published on the Future of Freedom Foundation website. The author argues that the Federal Reserve has engaged in monetary debauchery since it was established in 1913, printing ever-increasing quantities of paper money to enable federal officials to engage in ever-increasing expenditures for their welfare state and for their welfare state. And this has led to periods of easy money where the Fed has expanded or inflated the money supply, followed by economic recessions where the Fed raised interest rates to control price increases resulting from its easy money policies. During the past 10 years, the Fed engaged in one of its longest periods of easy money, capped by its extremely easy money policy during the COVID-19 pandemic. This easy money flowed into banks in the form of deposits, which were then invested in long-term federal bonds. These bonds were considered safe and secure, but when the Fed began raising interest rates in response to soaring prices, the bonds dropped enormously in value, causing a big financial strains on the big tech industry and causing depositors to withdraw their money from banks to take advantage of higher interest earning investments. The two banks that have failed so far had to liquidate their safe and secure long-term bonds at an enormous loss, leading to a bank run. Mr. Hornberger argues that the Federal Reserve's paper money system has been a monetary disaster for the American people, and that the country's finest monetary system was the gold coin, silver coin monetary system that existed before the Federal Reserve was established in 1913. He claims that the system was a major factor in the greatest period of economic prosperity in history, especially from the end of the Civil War into the early 1900s. In conclusion, he suggests that the Justice Department's investigation into the banking crisis is unlikely to acknowledge the Federal Reserve's role in the crisis, as the Fed plays a sacrosanct role in America's welfare warfare state. However, the author argues that the American people would be better served by returning to a gold coin, silver coin monetary system and abolishing the Federal Reserve altogether. And I would add, abolishing the federal government would be the best thing possible. Let's get all these lazy government workers off our books, and then we no longer lose 20, 30, 40% of our income to a government that hates us. All right, well, that's everything I had to say for today. I hope everyone has a wonderful weekend. Please watch some college basketball, or if you don't like basketball, check out the World Baseball Classic and some spring training. Anyways, hope everyone has a great weekend. If you need anything from me, please go to dsafinancialgroup.com. All the contact information is there. Hope everyone has a good weekend, and I'll talk to you next time. Adios.